Good afternoon and welcome to the second in a series of 3 events the Davidson Institute is hosting with ezyCollect. And today's session is all about managing cash flow. My name is Lali Wiratunga, and I'll be your presenter for this session. Before we begin today, I'd like to acknowledge the traditional owners of the land which I'm presenting to you from today. In my case, I'm presenting on the lands of the Gadigal people in Sydney. And I would like to pay my respects to elders both past, present and emerging. I also acknowledge and pay respects to those of you participating who identify as being Aboriginal and Torres Strait Islander and recognise the diversity of Indigenous people, countries and culture in our lovely land of Australia. So, someone once said to me, profit is just a matter of opinion. It's something your accountant puts together for you for tax purposes. Whereas cash is real. Cash is king. Cash is the lifeblood of your business. To ensure that the lifeblood continues to pump through your business, you need to understand what cash flow is and how to keep it flowing. So, before we get into today's presentation, a piece of housekeeping I'd like to let you know about is that the information contained in this presentation is general in nature and has been prepared without taking your objectives, needs, and overall financial situation into account. So we recommend for appropriateness, and if you want to have some help related to your own financial situation, seek appropriate advice from a professional, a banker, a financial advisor, a tax accountant, or another advisor. So let's go into today's agenda. And first of all, we're going to talk about the lifeblood of your business. And you first need to understand what is cash flow, then where you can find cash hiding in your business, and how you can use that information to improve your cash flow. Cash flow might be simply the money going in and out of your business. But while it's vital to the continued operation of your business, you may be able to operate without profit for a while, but you cannot operate without cash. To begin understanding your cash flow, it helps to understand what is going in and out of your bank account. You can do this by putting together a snapshot of your cash position. So, start by identifying your cash inflows. The majority of your cash will be received from making cash sales. However, some of your customers may be on account. That may mean that instead of receiving cash, you give them an invoice to pay you. You give them an invoice instead of pay you at some point in the future. And these are known as debtors or accounts receivable. You may have some other income, such as interest or dividend income, or maybe even some subsidies or grants. And this also needs to be included. Once you have your inflows, you need to identify your cash outflows. And these will include your payments to suppliers who are known as creditors or accounts payable. And you should record all your general expenses such as rent, electricity, accounting fees, and other overheads. If you have employees, include their wages and salaries. If you have borrowings, include interest and principal repayments. Don't forget the other expenses, particularly the ones that happen infrequently, like paying GST, tax, your PAYG, super, and other insurances that you might have for your business. Now, take away your outflows, your inflows, and what that gives you is your ending cash position. Once you have your ending cash position, you will have one of 3 results. Firstly, a positive cash flow. If you consistently have a positive cash flow from this, it provides you with opportunities. You can opt to spend it now, to take advantage of a current opportunity. You could then save the cash to pay future bills or cover future negative cash flows. Or you can invest the money into growing and developing your business. Secondly, a neutral cash flow. A neutral cash flow means you do not have to find any more money to fund your business, but it also means your opportunities to spend or save or invest are limited. Thirdly, you have a negative cash flow, or you can have a negative cash flow. Don't panic about this. It may only be a short-term challenge. And this does not mean there's anything fundamentally wrong with your business. All it means is you need to find the cash to cover that negative cash flow. You might get the cash from your own pocket. If you're a small business owner, you may take on a partner who injects cash into your business, or you may need to come to a bank. and borrow the money. So the information you gather from your cash position will help you put together a cash flow budget for your business. A cash flow budget is one of the most useful tools to understand and manage the cash in your business. It's a good idea to do a cash budget at least monthly, and you can do it more often if you'd like to. You can start out with your beginning cash. That is the cash in your bank account. You can add to it all the cash you expect to come into your bank account for that month from cash sales, debtor collections, and any other cash that you may receive. You'll need to factor in timings such as how regularly your debtors may pay you. Is that in the same month as your invoice or how long after? Adding your beginning cash to the cash you'd expect to receive will let you know how much cash you have available to pay for your outflows. You then need to record how much you think you will pay out for each month to your suppliers, which also, they're also known as your creditors. And here you may include all general expenses like rent, advertising, consumables, cleaning, maintenance, and so on. But again, don't forget your GST and tax payable on your BAS statements and other things you may need to pay for, which might be infrequent. If you employ people in your business, you will need to include wages and salaries. And of course, don't forget the PAYG's payments and super. And also include any debt repayments, including principal repayments, interest, and payments for your leases. And any other payments you may make, such as dividends being provided or drawings down that you may have as an owner. Once you have completed your cash budget, you can then decide the best way to treat positive, neutral, or negative cash flow positions. So now we've got a fair understanding of the basis of cash in and cash out. We need to understand a little bit more about the timing of cash flow and where the cash tends to pool or hide in your business. Now, I'll just remind you, please do feel free to use the functionality on today's meeting from Zoom to actually add in your questions, and we'll try and address some of those at the end. Thank you. So a great way to understand where cash hides in your business is a concept known as the working capital cycle. Every business, every organization has a working capital cycle, but they're not all the same. So let's start out with a generic working capital cycle, then let's talk about some of the variations on that cycle. So you start off with the money or cash sitting in your bank account. Now your money sitting in your bank account, it's not necessarily good to you just sitting there. You may want to use that cash to make profits. To do this, you first need to buy something that you can sell. In this case, you're going to take the cash out of your bank account and go and buy some stock. The stock comes in and you fill up your store, your warehouse, or your garage at home, wherever you put your stock. Then you look to sell the stock as quickly as possible, as this is now cash tied up you cannot use for other purposes. For some of you, when you sell your stock, you can get your cash straight away, either as cash or credit cards, for others through that you sell on credit. You issue invoices and end up with things called debtors or account receivables. This is where you become the banker in effect to your customers. What you're doing is you're lending your customers the money to buy your goods or services. What do we hope these debtors do? You hope eventually they're going to pay you, and that with that payment will come money back into your business. The reason we're interested in this cycle is it's all about how long it takes for your dollars, for your money, to go all the way around the cycle. And the faster you turn the cycle, the more cash you will have available to you, allowing you to grow more rapidly, reduce the risk and cost of using short-term debt, and potentially improve your profitability. We said at the start, not all businesses are the same. Some of you may be retailers and will look at this and saying, well, I get everything in cash and credit cards. I don't have any debtors. And you'd be right. Your cycle just goes from cash in the bank to stock and back into cash. That's a little bit simpler. However, the biggest killer of all retailers, no matter where they go in the world or who they are in the world, it's poor management of stock. A bill comes in and the organization can't pay for it because all the cash is tied up in the stock on the floor. And you've got to turn your stock and make sure your cash is working for you. And then there may be others of you who are saying, well, hold on a second. I'm actually in a service business. I don't actually have any stock. And again, we effectively agree with you. You have something that acts a little bit like stock, and it's called work in progress, or on this screen, WIP. Basically, you take on a job from a customer, you do all the work for them, then you send out an invoice. And when you're doing all that work, before you can send out the invoice, what do you have to do? Do you have to pay out wages, rent, utilities, and so on? If you do, then that's using up your cash. Then you send out an invoice and wait for your customers to pay you. More time before your dollar comes back into the business. Whatever your business, you have a working capital cycle. There are, of course, variations that we discuss, but it's important to understand how the cash flows through your business so you can find where your cash is hiding and speed up your working capital cycle. You usually measure the speed or turn in days. How many days on average does it take for that stock to sit on the shelf before you sell it? How many days on average does it take for you to collect your debtors? And these days are called turns. Turns are days, days are time, and of course, as we know, time is money. Turning your working capital cycle helps you free up your cash flow. So we now know a little bit about how cash flows, and that if your working capital cycle slows down, it can cause your cash to pool or hide instead of flowing. Now we need to work out how to get your cash flowing again. And to do this, we're going to look at each element of the working capital cycle: stock, work in progress, and debtors, and the actions that businesses can take to improve their cash flow. So a very common place that cash can hide in your business is in your stock. So let's start there. The stock pool is a brainstorming tool to help you identify where you may be able to free up cash. The stock is basically, if you could consider, like a big swimming pool where all your stock's sitting. And to fill up the swimming pool with stock, you need to purchase it. By selling the stock, in a perfect world, we'd love for our purchase to arrive on the day we made our sales. So, here we're talking about emptying the pool through sales. In effect, we would just have a stream rather than a pool. But for most of us, we're not in that perfect world. So we do end up with stock pools. If your stock pool is getting larger and chewing up a lot of your cash, you need to start working on how to shrink it. To shrink your stock, you have two options. You can either slow down purchases or you can speed up sales. Let's start with purchases. The brainstorming tool, your stock, is to help you think about how to reduce purchases and get to as close as possible as just in time. So let's first of all take a look at your product mix and identify which items are turning over quickly and those that are slower to move. Consider whether that slow-moving stock is worth the cost of holding it. If it's a product that brings customers to your business, who then buy other stock, or it has a strong profit margin, then it may be worth it. Otherwise, look to offload it as soon as possible. Then take a good look at your stock management system. Can you improve that system? Does it provide you with accurate and timely information? Do you do stock takes and match it to the system to maintain accuracy? Do you receive alerts when it's time to order more stock? Does your pipeline management help you make more accurate purchases and think through your purchase forecasts? Particularly in highly seasonal businesses, some of you may be experiencing in this lead up to Christmas. Also consider buying less but more often. While a discount on bulk purchases may seem attractive, is it enough to outweigh the cost of storing the stock, that bulky stock, and having your cash tied up until such time as you can sell it? A temporary solution to quickly reduce stock is to simply stop buying it for a short period of time. So that's a few things to consider, quite a few things to consider to help you reduce your stock by slowing down the inflow. The other side of the equation is, of course, to increase the outflow by improving sales. One way of improving sales, one way of improving those sales is to incentivize your customers to buy more often by offering them a discount. Another is to incentivize your staff to sell more by offering commissions or bonuses, or perhaps even offering additional sales training. But consider whether your marketing is effective or whether perhaps you may need to try something different. You could also try packaging slow-moving stock with a product that does sell well, or try selling with a different marketplace, such as eBay. And if none of these things are working for you and you're still holding onto this stock, Maybe you could see if you could donate it to a charity or a local school that will give you a little bit of goodwill or even PR in your community. And at the end of the day, you might be forced to write it off. And if so, write it off sooner rather than writing off later. But of course, talk to your advisors for further information there about your circumstances. That's just a sample of some of the ideas to shrink your pool and to increase your sales. Now, of course, there are different types of businesses. So let's talk about a service business. Instead of your stock, you need to look at your work in progress pool and how you can free up cash there. Let's have a think about this work in progress and how it flows through your business again. Again, we're going to use that concept of a pool to brainstorm ways of managing work in progress. We start out with the inputs of time and skills. If you need like the resources to complete certain jobs, so you can send invoices out. What we're interested in here is having the right amount of resources to complete jobs in the fastest time possible. And you're usually paying for the time, so you have access to resources. If you don't use that time, you have lost that cash. So how do we make sure that you have the right amount of time and skills to complete the work you need to do? And it's going to, I think, maybe a place to start is to have a pipeline management system. And that can give you a good indication of the jobs coming up and the skills, people, functions, and other equipment you might need to complete those jobs. And of course, you might need to hire the right number of people with the required skills, attributes, capabilities, and the right amount of equipment or space with the right attributes. Can you use contractors, part-time or casual, instead of full-time employees? And this allows you the flexibility of increasing and decreasing the resources as the number of jobs change. Do you know the capacity constraints of your resources? That is how much work they can actually produce and in what time frame. Ensure the work being undertaken is productive. That is income-generating tasks or tasks that will upskill for work in the pipeline, or ensuring admin is completed correctly. Are you effectively rostering resources? Ensuring you're not using loads of expensive staff members at the same time or using inexperienced staff at the same time? And are you ensuring you're not carrying excess staff or equipment? And that's all about making sure you keep your employees and your equipment busy and occupied so that on revenue generating activities. Now, on the other side, to have the right resources to ensure jobs are completed on time and you get these invoices out as soon as possible. This gets back to efficiency. What we want to do is to finish every job as soon as we can. You need to make sure your processes are efficient. You need to make sure that your employees stay motivated and productive. And are there obstacles or bottlenecks that are hampering completion of jobs? Is there process monitoring in place so you know what stage your jobs are at and you get early warning when they may be getting off track? Part of monitoring is to know what is the time to completion. And what keeps it all on track is the productivity of your staff and your equipment. In a service business, you need to make sure you're having enough jobs to keep everyone occupied, to keep all your capacity used. And that is being done effectively, efficiently, productively as possible so that you're getting the jobs done and the invoices out the door as soon as you can. The better you can manage this, the less chance there is of cash getting caught up in this part of your working capital cycle. So a third place cash can hide in your business is in debtors. And again, we're going to use the debtor pool to brainstorm and help you identify where you may be able to free up cash. So we're thinking about debtors like we have with stock and work in progress. There's a big swimming pool. You can fill it up by making credit sales, and you can empty it by collecting the cash from your customers. The key starting point when offering credit sales is to consider what's your credit policy. And is it because after all, you're essentially lending your customers the money to buy your goods and services. Who are you prepared to lend that money to? And what criteria do they need to meet? This may mean that the new customers need to establish a good track record with you before you offer them credit terms. And at the very minimum, it's prudent to request credit checks. You also need to consider how much you're prepared to lend and for how long. Your credit terms could include things such as deposit requirements, progress payments, payment options, and whether you want to be paid in increments of 7, 30, 45 days. And this should all be disclosed on your invoice. And your invoice needs to be issued the same day as you provide the goods or services. Don't lengthen your collection period by not issuing invoices promptly. Once you have money out there, you need to ensure you have the systems and procedures in place to collect those invoices in line with your terms. Consider, can you have a reminder system as the due date approaches, but definitely follow up as soon as a payment is late. And of course, ezyCollect have a plethora of support here for you. And follow up in person on the phone, not just as an email, because sometimes emails can be overlooked. That squeaky wheel that gets the oil, turning so you're on the phone, chasing your payments, may mean you're more likely to get paid sooner. In some industries, the offer of a discount can incentivize some people to pay earlier, but it may also have the penalty for late payment as part of your credit terms to go with it. Particularly when you're dealing with large organizations, ensure you develop a relationship with the right contact. You need to be following up with the decision maker, not just the processor of payment. Sorry, I just moved forward a bit too soon. So keeping an aged debtor listing helps you stay on top and who is paying you and who isn't. You could also consider using an external debtor collection agency or even invoice finance. Whatever method you choose, shorter term payments, phone call, a discount, etc., you might want to make sure you get your cash in as soon as you can, because the sooner you can get your cash in, the better your cash flow should be. So remember, your cash hides in your working capital cycle. So monitoring that cycle regularly and making sure it's turning as quickly and as efficiently as you can is really important for your business. So in just over 20 minutes, what we've covered off is what is cash flow, and remembering that cash flow budget is one of the most effective tools to help you keep an eye on your cash flow. We also look at the working capital cycle to see where your cash can pool or hide. Then we looked at just a few ideas to get the working capital cycle moving faster to improve your cash flow. And of course, there's much more we can discuss. And at the next one of these webinars, the third of 3, we're going to be covering off something called optimizing cash flow. And the ezyCollect team will share with you after this session further information about that next session. So I'm just going to pause. And if you haven't put in a question as yet, there's still a little bit of time to start typing your questions in. As I said, if you're on a computer, you'll find there's a question panel that you can access and you can ask your questions there. I think I can see some questions. I'm just going to have a quick look. Let's have a look. Okay, thanks, Lali. Very informative session. What will increase cash flow from assets? That's the question that we've got. So let's just go back a few slides to see how we can support the person who asked that question. So, if we think about, hopefully the person who asked that question has also had an opportunity to reflect on the kind of ways we can actually improve our cash flow through the 3 methods we've given there, through the work in progress pool, through the stock pool, through your debtors pool. But of course, the stock pool being, your stock is also one of those assets you've got within your business. And we kind of gave a number of ways in which you can improve your stock pool by, playing with the mix of the product mix you have. Thinking carefully, just take the example of product mixes. Do you actually are you selling the right products at the right time? Do you have too many products? These are things to consider. Are you selling just in time? So I think that's just an example of some of the things you could look at with your stock pool. So I'd encourage you to have a look there for the person that asked that question. There's no further open questions that I can see, but I'll pause just to see if anything comes up in the next few moments, and I'll just whiz to the last of our slides. Now, again, thank you for your time as a team for sharing 30 minutes of your time with us. Really appreciate it. The ezyCollect team will, shortly after this event, they'll be sharing with you a question and answer, so you can actually give some feedback on today's webinar. And of course, they'll be sharing with you access to the presentation from today. So once again, thank you. We really appreciate you joining us for today's session.